Welcome back to The Explainer. Okay, today I am firmly putting on my professional sell-side equity analyst hat to walk you through a really rigorous, fundamentally driven deep dive into AAR Corp. They trade under the ticker AIR. Now we're going to act strictly based on the provided financial snapshot to build a fully documented valuation profile. And let me tell you right up front, what we've uncovered here is literally a valuation mystery. We're looking at a stock that is absolutely soaring right now, but the underlying cold hard math, well, it tells a wildly different story. To figure this out, we're going to systematically walk through a performance snapshot, run our absolute valuation models, explicitly call out our model limitations and missing data because transparency is everything. Then we'll hit historical relative valuation, look at the growth justification, and wrap it all up with a final analyst verdict.
So let's jump right into the performance snapshot and look at what I'm calling the Great Disconnect.
As an analyst, my entire job boils down to reconciling a stock's market price with its actual intrinsic value. With AAR Corp, we are staring down a massive, glaring anomaly right out of the gate, negative 632.26%. Take a second to process that number. That is the calculated margin of safety for this stock based on its fundamental free cash flows. Now, what's absolutely fascinating here is that despite this terrifyingly negative margin, the stock has been on a total tear. I mean, it boasts a year-to-date return of over 35% and a trailing 12-month total return of over 100%. The market is just enthusiastically buying this up, while the fundamental math is practically screaming caution. And this right here perfectly illustrates the mystery. The current market price sits at roughly $111.90, which honestly is not too far off from its 52-week high of $127. But then you look at our fundamentally derived fair value, based purely on the actual cash this business generates, and it sits at a meager $15.28. We are looking at a market price that is, for all intents and purposes, mathematically detached from its calculated baseline. It's like paying for a mansion and getting a garden shed. Now, you guys already know margin of safety is a core tenet of value investing. You always want a positive margin to protect your downside against, analytical errors or sudden market downturns. So a negative 632% margin, that implies we aren't just paying a premium, we are paying a towering, monumental premium over the mathematically derived absolute value. There is zero cushion here, literally none. Let's move on to our absolute valuation models and try to actually ground these numbers in reality. For us sell-side analysts, the gold standard is, of course, the discounted cash flow, or DCF model. We project the unlevered free cash flows a business is expected to generate into the future, and we discount them back to today's present value. It's the purest way to value an asset, really, because it cuts through the noise and asks one simple question: how much actual cash is this business going to put into our pockets? Based purely on the provided data snapshot, we actually get two very different DCF outputs depending on the inputs we choose. Using a standard free cash flow base, the model spits out that terrifying $15.28 fair value we just talked about. Now, if we tweak our assumptions, say substituting earnings per share as our base instead of free cash flow, the model gives us a much higher, much more generous fair value of $73.83. But here is the critical takeaway. Even under that highly generous EPS-based DCF, the current $111 market price is still heavily overvalued, carrying a negative 51.5% margin of safety.
So, how else can we value this? Well, that brings us to model limitations and missing data.
Look, rigorous analysis is just as much about recognizing the limits of your data as it is about running the numbers. We have to explicitly state what we cannot calculate with the provided snapshot. We are totally excluding three major models today. First, we can't run a sum of the parts valuation because the provided docs lack distinct reportable business segment data. We just don't have it. Second, we have to skip adjusted present value and residual income models completely. Why? Because the multi-year capital structure line items required to properly value things like tax shields and book equity charges over time, they just aren't present in this specific data set.
Finally, and perhaps most importantly, we can't use the dividend discount model. The crucial point here is that AAR Corp has a 0% dividend compound annual growth rate across the trailing 12 months, the 3-year and the 5-year periods. You need a consistent growing dividend policy to make that work. Without it, the DDM is mathematically unusable for this specific equity. Since absolute valuation is looking grim and we're limited on other models, let's pivot to historical relative valuation. Now, because our snapshot does not provide external competitor data for a peer group analysis, we have to make an external assumption and benchmark AAR Corp against its own historical baseline to see how current multiples stack up against the recent past. And honestly, we're getting some really mixed signals here. If you just glance at the price-to-earnings ratio, AAR looks like a total bargain. The current PE of 24.81 is actually a 53% discount compared to its bloated 3-year average. But you've got to look deeper. The market is currently paying a nearly 20% premium on the price-to-book ratio and a 14% premium on enterprise value to EBITDA compared to 3 years ago. Plus, if you dig into the EV to sales and EV to assets ratios, those are also up significantly versus historical averages. So, to sum up the relative valuation, yeah, the raw PE ratio has cooled off a bit, but AAR Corp is undeniably more expensive on an operational and asset level today than it has been in recent history. We're trading at elevated multiples across almost every major enterprise value metric. Which brings us to the elephant in the room, the growth justification, or the bull case. So think about it. The fundamental DCF says it's massively overvalued. The historical multiples say it's trading at a premium. Why on earth is this stock up 35% this year? Well, take a look at this. The market is looking directly at ARR's recent operational momentum. Over the trailing 12 months, net income growth hasn't just increased, it has absolutely exploded by an astonishing 1,446%. When a company suddenly multiplies its net income by that kind of magnitude, the market tends to just throw traditional valuation models out the window and aggressively bid up the stock price, anticipating a completely new hypergrowth era.
And this data proves that the net income spike isn't just some clever accounting trick, right? Earnings per share has surged nearly 785% over the last 12 months. And most importantly for our DCF lovers out there, free cash flow, the actual tangible cash generated, has grown 361%. This broad-based triple-digit fundamental growth is exactly what's driving that 100% trailing total return for shareholders.
But this brings us to the ultimate question that you have to answer as an investor. Is a temporary, albeit massive, 1,446% profit spike actually worth a negative 600% margin of safety on the stock price? Are we witnessing a permanent step up in AIR's fundamental earnings power, or is the market just blindly pricing in a best-case scenario that mathematically cannot be sustained? Time for the final analyst verdict: exuberance versus fundamentals. We have to balance the sheer exuberance of the market right now with the cold, hard math of our models. It's a tough balancing act. On one hand, AAR Corp is demonstrating phenomenal operational efficiency right now. Their return on invested capital currently sits at 7.15%, which is an 87% improvement over its 3-year average. They are putting capital to work way more effectively than they used to. But on the other hand, the current $111 market price carries an extreme valuation risk. I mean, at $15 a share in foundational free cash flow value, any tiny slowdown in this hypergrowth narrative could trigger a massive, painful repricing event. Which leaves us with this final provocative thought. As value investors, we know that eventually gravity always takes hold. Always. Will AR's future cash flows accelerate fast enough to somehow eventually catch up to its soaring market price? Or is a fundamental correction practically mathematically inevitable? I'll leave you to ponder that based on the evidence we've unpacked today. Thanks for joining me on this deep dive explainer, and as always, keep your eyes focused on the numbers.